In Canada, William Lyon Mackenzie King led a liberal rebellion in Upper Canada in 1837. The reason for that was the family compact had decided that they could get rich by investing in canals, because lots of people all over the world had built canals. They were incredibly profitable, and so they built canals everywhere. And of course, they built too many canals. And when you have too many canals, they're not profitable anymore. The canals couldn't repay their interest to the Bank of Upper Canada. The Bank of Upper Canada started foreclosing on loans and mortgages, and people rebelled. So in a way, our country was built on a stock market crash. I don't know what would have happened if the Bank of Canada hadn't overinvested in canals. Maybe we'd still have a colonial governor. Kindleberger goes through these, there's one of these at least every generation, sometimes a couple every generation. Kindleberger goes through these and he says, in every case, what happens is we start off with something that creates abnormally high returns for one set of investors. Trading companies, canals, railroads, electrification in the 1920s, transistors and plastics in the 1960s, the internet, the PC more recently. In every case, a first set of investors gets very, very rich and makes returns that are much, much higher than normal. This is Charles Kindleberger, by the way. The first risk takers make big, win big, everybody else wants in, and there's an urgent demand for deregulation, so everybody else can get in. So for instance, in the recent boom, hedge funds. We all wanted to get into hedge funds, so they came up with funds of funds, a regulatory escape clause to kind of let ordinary people invest in hedge funds. Probably shouldn't have done that, but they did because of demand from the public. Money pours in, and we get a positive feedback. Money pours into the stock market. When money pours in and people are demanding more and more shares of stock, the price goes up. People see the price going up and they want to buy even more shares, and you get a positive upward spiral of share prices fueled only by demand, not by the actual return that the shares can generate. Until you get what's called a Minsky moment. This is Hyman Minsky, who was ignored by the economics profession for many decades, but I think was right. And he basically says this upward spiral keeps on going and going and going until a point arises where, kind of like Wile E. Coyote, we suddenly look down and we realize that we ran over the cliff, and it's at that point when we look down that we start falling. And that's the way the stock market does work, because this expectation, this positive feedback of unrealistic expectations can sustain stock prices, kind of like the coyote running over the cliff and staying up in the air until it goes down. That's a Minsky moment, and we just had a Minsky moment. After the Minsky moment, money pours out. Everybody wants to sell. Because everybody's selling, the price goes down. The people see the price going down. They want to sell more. And you get into another positive feedback spiral, but this time with prices going down. And money bleeds out, and ultimately you have a market crash. And human nature is what it is. There's no point in pretending that we're better than we are. That's kind of what we are. Investors don't want it to be over. And so fraudsters step forward and say, I have other investments. Maybe you missed out on the internet, but I've got other investments that will give you really high returns. And the whole thing kind of gets short-circuited and the money actually disappears. And that's even worse because it undermines trust in the financial system. There's a desperate surge for high returns, and there's something called contagion. This speculative fever leaps from market to market. It jumps from the stock market to the commodities market to the real estate market. And sometimes these crashes come in sequence. You have 3 or 4 of them in different markets, kind of one after the other, before the thing finally peters out and people go back to realizing that they're just going to get normal returns from now on. So it's kind of a cyclically punctuated equilibrium. And there's a political economy cycle, too. We re-regulate the market after each of these episodes. We put in tough new regulations, and then when the next new technology comes along, a group of people get rich, everybody else wants to be in on it, and we have to deregulate madly. And we do this over and over and over, and kind of there's sort of an endless cycle of regulation and deregulation that kind of makes you want to be a Buddhist, I guess, if you study financial markets. There are residual social benefits. The big boom in the 1920s was electrification. The big boom in the 1860s was railroads. After those booms, we had railroads and we had electricity. We had a lot of poor investors, but we had all the infrastructure that came from those booms. And this boom will leave infrastructure, too. So I can't conclude without mentioning this year's Nobel Prize winners in economics. This is Oliver Williamson. And he got the Nobel Prize for looking at the ways people organize themselves. And he basically looked at every conceivable way people can organize themselves in large groups. And he concluded that there are only two ways people can do this. One is command and control systems, armies, the Roman Catholic Church, corporate hierarchies. The other is markets. People look at price incentives and they do what they think will make them rich. And those two ways of organizing, one kind of top-down and the other kind of self-assembly, bottom-up self-organization, are the only ways. There's no other ways that people have ever discovered that he can't fit into one or the other of these or some mixture of the two. And that's kind of bad news for people who talk about third ways. But each one of these has its benefits and its problems. There are rules and regulations that make command and control work. There are price incentives that make markets work. But we have government failures, we have command and control failures, and we have market failures. And both of them are problems. Both of these ways of organizing ourselves seem to have very deep roots. The primatologists are doing wonderful work where they show that baboons and chimpanzees and other primates actually tend to organize themselves very spontaneously into pecking orders, kind of dominance hierarchies, and they seem to also do something that's kind of like trading with each other, although that's more controversial. So these are ancient things in our beings. Command and control works surprisingly well, maybe because of this ancient evolutionary thing. Maybe Neolithic hunters who were going after a mastodon kind of were better able to get the mastodon down if they all worked together. And if they were all working separately, maybe they got trampled or something. But anyway, there seems to be a surprising ability of human beings to work in hierarchies, more than you would kind of think. Not always. We have Abu Ghraib, we have the Indian Act, which tries to run Indian reserves hierarchically. We have the swine flu vaccination program in Alberta. Command and control doesn't always work. There are information costs, there's red tape, there are misaligned incentives, there are all kinds of problems. And command and control works really, really badly when it comes to creativity. Remember Schumpeter's creative destruction, what raises living standards. This is a tractor factory in Belarus in 1992. It's using exactly, precisely the technology that was in place there when the Red Army conquered Belarus in the 1920s, in the Russian Civil War. No change at all. And that makes sense, because bureaucrats don't like creativity. That just complicates things, right? They like things to be well organized. And the result is that command and control doesn't work well with creativity. Markets work surprisingly well too. Adam Smith famously said, "It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own self-interest." That's true. If we actually went into a bakery and said, "Well, I'm really hungry, just give me something," I don't think that would be a good way to plan your life. I mean, it just wouldn't work. The baker wants money, and it works. Smith said that when we all work this way, a kind of an invisible hand arises. And that's just this spontaneous organization, self-organizing economic systems that amount to market economies. Market failures happen too. Although this is the other Nobel Prize winner of this year, Elinor Ostrom. She's studied a lot of market failures, and she finds that they actually sort themselves out surprisingly well. So this is a Mongolian cow. And one of her most important studies looked at Mongolian pastures versus pastures in similar terrain in China and Russia. China and Russia had hierarchical command organization of where cows pastured and who could pasture stuff where. In Mongolia, the herdsmen worked it out for themselves in a kind of a quasi-market system. She looked at, this is Google, I can't see this, this is a map of Mongolia from Google. But apparently if you look at similar terrain in Mongolia, China, and Russia, you see that the Mongolian terrain is all green and the Russian terrain is all brown because of overgrazing or just neglect of the land. And she argues that if we actually leave people alone, market failures do tend to sometimes at least sort themselves out. Maybe we haven't quite got that with stock markets yet, though. Smith also argued that for markets to work, you need laws and morals. They don't just work by themselves. And so Smith wrote a second book, The Theory of Moral Sentiments. It was actually his first book, in which he said, look, human beings are constrained by what they believe is moral, what they believe they can get away with, what they believe they'll be punished for, and those constraints are essential to making markets work. If people just went out and did whatever they wanted, markets wouldn't work at all. And you can see that in Somalia. That's got to be the country with the least government in the whole world. It doesn't work well.